welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton. Live from our New York City headquarters, we are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
If you look on the last conference call, Elon Musk said that they would be in first production, sometime next year. So, the event was sort of like watching a movie with a lot of plot twists and special effects. And at the end, you're walking out, kind of scratching your head. You're talking it over with your friend, trying to figure out what you just witnessed.
A lot of managers earlier in the year had withdrawn from the large caps, thinking we were headed for a recession. It's not happening. Even though JP has built reserves are up over 100% year over year, they're still not at a level where you're going to be terribly worried. They're normal compared to the COVID years. So I think that overall, JP is going to lead the pack back up as the large caps come back into favor with the managers.
Before the print, we were looking for about 0.25% on core PCE. Now it's looking like it could be a little bit hotter, which is higher than what the Fed is looking for. So if you take a step back, we do think that the Fed is able to cut at the next meeting, but it's a toss-up and perhaps a bit higher than what the market is anticipating at the moment.
We got 1 hour to go until the market close. So let's take a look at the major averages here. We have a rally going on today. The Dow is doing the best of the three. It's up 377 points, let's call it 0.9%. The Nasdaq up about 0.4%. Let's zero in on the S&P 500 for a second because it is set for its 45th record close of the year with that gain that we're seeing today. And if you look at it on the week, it's also higher. It is the 5th straight week that it's seeing gains. We did have some economic data today, and it didn't seem like it was anything to necessarily spoil the party.
Yeah, we got September PPI, and I saw economists basically sum it up. Julie, your point saying, not really far from what they expected. Kind of showing some, suggesting more progress on that front. On the other hand, consumer confidence, that did slip a bit. So we know, high prices, inflation still top of mind for consumers there.
And it was also the first decline in about 3 months. It was unexpected to see that kind of a decline. But to your point, a reminder that consumers are still very much paying attention to inflation, cost of living. And so we'll see as we go through earnings season if that's going to be sort of more of a spoiler when it comes especially to consumer-oriented companies. But for today, what's really driving the gains that we're seeing on a sector basis is XLF. The financials today are gaining the most. Industrial's also doing pretty well, but the financials up big, and that's because, as we know, a lot of these companies coming out with their earnings, JPMorgan, Wells Fargo sort of kicking it off, in addition to hearing from some of the big asset managers. I'm just looking here for the banks. Here they are to get a bit more granular as to what we're seeing. JPMorgan up 5% here. Yeah,
so they reported, obviously grew with good results. Interesting note from Apollo's Torsten Slok today. He kind of crunched the numbers, Julie, and saw that really financials are among those sectors, just historically, that do in fact tend to outperform during a Fed rate cutting cycle that ends in a soft landing. I think he mentioned healthcare, consumer staples as well there. I think so. Obviously, these agree as good results. I think already you see investors in the street trying to sort of extrapolate for read-throughs to next week when the party continues.
Yes, or not. We'll figure out how these different banks are playing the decline in rates.
Yeah, for sure. All right, for more on this, banks kicking off another earnings season with JPMorgan, Wells Fargo, Bank of New York Mellon, all reporting solid quarterly results. But how long will good times last as lower rates make their way through the financial system? For more reaction to today's earnings, we're going to bring in David Ellison, portfolio manager at Hennessy Funds. David, it is great to see you. So let's start right there. Those banks, they reported results, Dave. Give me your take on those results. Did anything surprise you, Dave, in those reports?
Not really. I think fundamentally they're pretty much in line with what everybody thought, which was sort of a no news quarter in terms of credit and margins. I think the issue is that the big thing is rates have stopped going up, and so they're coming down a bit, taking pressure off deposits. That's helping margins. Credit's fine, but I think the big thing is the mathematics of the business is working in their favor for the first time in a while, meaning that they're growing tangible equity, they're buying back stock, and the book value is growing. So JPMorgan had an 18% year-over-year growth in tangible book. Now that's being helped obviously by earnings and being helped by the recovery or the decline in rates, which is helping the hit on asset that they had. So then that's going to continue. So the point is that you're growing book value at that rate. It's going to continue to grow roughly at that rate. And you could argue that's the same thing for a lot of the other banks. Obviously, the numbers will be different, but we haven't been in a situation where book value has been growing for a while. And I think that's a big part of what's happening here. I think second thing is, let's remember now, JPMorgan is a $4 trillion bank. The Fed's balance sheet is only 7 now, down from 9-ish. So the point being is that the banks are becoming a much bigger part of how the Fed is going to fund the government and how the Treasury is going to fund the government. And that's a value creator for them. And you throw on the fact that the market's at all-time highs, Wall Street is open, they're generating a lot of fees. So this is a bank that is, poised to become a very important player in the financial system worldwide, and be a partner with the Fed and not be sort of run over by the Fed. So I think those are the things that I see, is that, the Fed is shrinking, the banks are getting bigger, and because of that, more important and more profitable because of it.
Dave, to get back to net interest income for just a minute and zero in on that, not just for JPMorgan, Wells Fargo having sort of a similar experience. As you mentioned, with rates going down, with the Fed cutting rates, it means that these banks have to pay out less on deposits, but at the same time, they're collecting less on loans. And there were some questions going into this quarter how that was going to sort of balance out. Is that too balancing out in the bank's favor, and not just these two banks, but the ones we're going to hear from next week?
Well, it's in their favor as long as rates don't go down too much. I mean,
what's too much, Dave?
Well, too much would be to get, let's say, down to 2% or 1.5% or below 2% on Fed funds, because then your prime is going to be 5 or 4, and that's no good. And so I think that I know we're picking numbers, but I think it's a 3-4% cost of funds and a 5-6-7% yield on assets is kind of the sweet spot. And the hope is that you can stay there. The other thing is that, the banks have gone through a significant increase in rates and therefore loss of market value. That's coming back, and they're going to reposition and not want to go through that again. So, but I don't think it's all about NIM. I think there is the structure of the deposits, which, everybody worried about with Silicon Valley, and that's still out there. And so it's not so much the cost of your deposits, it's the structure and where's the next deposit going to come from.
Dave, what are some of the read-throughs for you from these reports to next week when more big names are on deck, Goldman, Morgan Stanley, Citi?
I think you'll see much of the same. I mean, what's happening to the goose is happening to the gander. And we can argue that, it may be a little different. Somebody may have some credit issues here and there. Somebody may have lower margins, but we're all fishing in the same pond. We all have roughly the same, meaning the banking industry all makes loans roughly at the same rate. They take deposits roughly at the same rate. It's a homogenized national market, which obviously, wasn't the case when I started, back in the 80s, which seems like forever ago. But, I think now it's a question of execution, and it's a question of being big enough to be competitive, not only with BlackRock or with, Blackstone or with what's going on internationally, but to be competitive with the Fed and in terms of their size and their ability. So that you want them to invest in the future, you want to invest in their business and not just sit there and worry about the margin every day, because that's a boring business that nobody really wants anymore.
Dave, to take a little bit of a left turn on another note, I do want to ask you about Bank of America specifically, because we learned today that Berkshire Hathaway's stake in the bank has now fallen to below 10%, so we won't be learning, on a sort of regular basis if there are more sales. What do you make of this change in ownership at B of A? Is it something that worries you at all as an investor? I know you hold both of these stocks, by the way, in your portfolio.
I don't, I really don't think it matters that much. At the end of the day, the fundamentals of Bank America are going to drive where the stock's going to go. Berkshire didn't make the stock, go to $5 in the financial crisis, and it certainly didn't make it go to $40 when it bought it. So I think, everybody, is interested in that, and it's sort of nice news. But at the end of the day, if the Bank of America comes out with a good quarter, the stock's probably going to go up regardless of what Berkshire does.
Fair enough. Dave Ellison, have a great weekend. It's good to see you.
Yep. Bye-bye.
Well, while big banks kicked off earnings season today with beats across the board, expectations for overall earnings growth in the third quarter do remain pretty modest here. According to data from FactSet, Wall Street's estimating a 4.7% increase in earnings. That is a big deceleration from last quarter before an expected rebound to end the year. For more on what to expect this earnings season and the implication for stocks, we want to welcome in George Mateo, KeyBank Chief Investment Officer. George, it's good to see you. So indeed, in the second quarter, we saw S&P earnings up 11%. The forecast for this quarter, 4.7%. How do you think that is going to sort of play out? How will companies do versus expectations? And will stocks still be able to rally?
Yeah, great to see you as well. And I think you're right to note that earnings this quarter are currently pretty, modestly priced in terms of expectations. I think we kind of noted that there was a deceleration from the prior quarter. But this actually will mark the fifth consecutive quarter of positive year-over-year earnings growth. And that's really something we shouldn't sneeze at. More importantly, in our view, we think that actually earnings will end up a lot higher than the 4% rate they're pegged at for right now. Why is that? Typically, actual earnings have exceeded forecast 37 of the past 40 quarters. The 3 quarters in which they didn't exceed expectations were March of 2020 and the third and fourth quarter of 2022. In that environment, we had the COVID pandemic in 2020, and then the Fed in 2022 was aggressively raising interest rates. Neither one of those is with us today. So as we think about this quarter, we think it's fair to say that on average, roughly 80% of the companies typically beat expectations. And this quarter is setting up to be the similar dynamic where we think most companies will actually exceed expectations. And by the time we get done with the quarter, Julie, we think we're poised to see earnings growth of close to 7 or maybe 8%, not just 4%.
As you look through Q3, George, then what about Q4 expectations?
It's a great question. And I think our view is a little bit more nuanced in the sense that as we think about the back half of this year, your chart was very illustrative in the sense that as we think about the back half of this year and then next year, the bar does get set higher. So we kind of see mid-teens earnings growth for much of next year, but that's a pretty high bar to jump over. So I would think that maybe in the near term, so long as the economy continues to grow, as long as we continue to see moderate inflation, we can still see pricing pressure pushing through in terms of top line growth, and also some cost cutting that will allow earnings to come in through as well. So I think the bar is set higher, but it remains to be seen whether or not it's too high as we approach the next year and earnings beyond that too.
And so as we come up on the 2-year anniversary of the bull market, George, and you're looking at this backdrop for earnings, where do you think we go from here? Do you think the bull market gets extended? Are earnings the catalyst, or are you watching something else that is going to continue to push that movement upward?
Well, I think we're still in this kind of mid-cycle environment where right now we've got decent earnings growth overall, as you mentioned. We've got a pretty good economy. We've got labor market, which is still pretty strong. And we also have just a general easing of inflation. Now, this week we got probably more noise than news with respect to the inflation numbers. So I don't think we learned too much on the inflation side. But generally, we see inflation moderating. And in that backdrop, we continue to see that risk assets are somewhat attractive. One of the flies in the ointment, however, is the fact that valuations are today rather full at 22 times forward earnings, relative to 15 times earnings at the start of this bull market. So we would not be surprised to see some moderate pullback perhaps in the near term. We still have a lot to digest with respect to political noise as well. But if the election year playbook plays out, we think there's a good chance that we may be on a pause. We could see further gains as the rest of the year plays out into next year as well.
What about the Fed, George? Let's say they did decide to pause in November. What do you think the market reaction and response would be to that?
Well, it's a great question. I think there's a lot to cover, a lot of ground to cover between now and then. Most notably is another employment report. And if it's a strong one, maybe it would suggest the Fed would likely pause. That said, it would really kind of take some strong economic data to kind of get the Fed probably off the sideline, onto the sidelines, I should say again. And if that happens, again, I think the market will probably rejoice the fact that the overall labor market is still pretty strong, and the recession scenario is really off the table at that point.
What kind of sectors are you looking at right now?
Yeah, we have a general view on quality. That's really one of our prevailing themes. We really want to be in quality companies that trade at reasonable valuations. We like companies that have strong balance sheets and really generate high return on capital and high return on invested capital more specifically. We also think it's important to look at companies that really are kind of poised to benefit from this mid-cycle phenomenon that we talked about earlier. Some of those companies reside in the cyclical sector, but again, focus on companies that have high quality balance sheets. We like certain names in energy and materials, and also financials. Just based on your prior guesses' comments, we still think that the banks have some room to run as well.
What about technology, George?
Great question. It's a big sector. It's something you can't avoid, and I think it really deserves some representation in every portfolio. We're a bit more picky, though, with respect to the certain names of technology we like. We think certain names are probably poised for a bit of a pause. We also see the market broaden out, and by that I mean beyond this Magnificent Seven stocks, we think there's going to be broader participation as well. And then finally, we also like healthcare for its defensive growth posture elements as well.
George, good to see you. Thanks very much.
Thank you very much. Appreciate it.
We're just getting started here on market domination. Coming up, Tesla shares hitting reverse today after the company's long-awaited robotaxi event failed to impress investors. So what's next? We'll break it down on the other side. And at 3:30, it's the latest edition of our series, Goodbye or Goodbye. We'll take a deeper dive into two stocks to help you make the best moves for your portfolio. Stay tuned, more market domination still to come. Tesla shares are sliding today after the company's long-awaited robotaxi event failed to impress investors. CEO Elon Musk said the company hopes to be producing the Cybercab before 2027, but he didn't offer any details on where the cars will be manufactured. He added that consumers would be able to buy a Tesla Cybercab for under $30,000. By and large, even big Tesla bulls on the stock said they wanted more details. And one of those bulls is Adam Jonas over at Morgan Stanley. Of course, he still says it's a top pick, right? He still loves the stock, but he said it didn't meaningfully advance the narrative of Tesla as an AI company. He said he was disappointed with the substance and detail of the presentation. And he says he expects it to continue to be under pressure here. And really what it seems he and other analysts wanted was, again, that more granular detail. What exactly is the technology going to look like? Who's going to make it? How's it going to be made? How is this all going to work? You know, these guys like to dive in and get technical, and Musk did not indulge them.
They want to make a model out of this,
right?
Which is here's another theory which I have, which is that I know that was definitely the theme, right? Well, you know, where's the meat? I want more details, more numbers. I want more timelines, especially on the street. How am I supposed to model vision and marketing and branding? I also wondered how much of that stock reaction today, I mean, you can see that we're down 8% here, was also because they didn't get any info on that lower price model.
Yes, for sure.
And I went, right, because I thought it was interesting when we talked to shareholders leading into that event. We talked to Ross Gerber, right? And we're kibitzing with Ross about robotaxi. But then we asked Ross, what if you got, Ross, some info, some news on that lower price model? And his eyes lit up.
He didn't think it was likely.
He didn't, but wow,
he said
did
that
he
would be
jump
great.
off the screen with that? And you didn't get that.
Two more things to mention. One is that for this being a company where Elon Musk has said, don't buy us because we're a car company, buy us because we're an autonomous and AI company.
Yes.
The stuff that they showcased here was not all autonomous. And again, Adam Jonas in his note points out that the van, the robo-van, he says it's not clear if this vehicle or the Cybercab were operating fully autonomously on the closed course. He says the same of the Optimus robots that might have been remotely controlled. So, you know, so there was, if you're trying to make your name as an autonomous company and the stuff that you're showing is for the show, I will say there were a couple bulls out there who were pleased with the event. It will not surprise you to know that one of them was Mr. Dan Ives over at Wedbush, who said that last night the event was a glimpse of the future of Tesla and next generation transportation for consumers. He said it's the inflection point for Tesla from an EV maker to this bigger thing that Musk is trying to build. Yeah,
the robots did get a lot of attention, though.
They did.
They really did.
They were dancing,
talking
apparently.
To people, serving drinks, it looked like.
Yep.
I will say, though, there was venture investor Josh Wolf saying on X, here's what he said about the robots. He said, not at all AI, totally worthy to celebrate low latency remote control, but totally dishonest to demo these as autonomous robots.
I love it in the tech world when low latency remote control. It's such
throwing it down very hard.
Woo. Okay, let's talk more about Tesla's robotaxi now. Joining us now, Kevin Paffrath, financial advisor and YouTuber Meet Kevin. Kevin, I know you were watching that event very closely as well. Now, you still have some Tesla in a retirement account. I know you have it, I believe, in one of your ETFs as well. So as an investor looking at that event last night, do you go out there and buy on this dip that you're seeing today?
Well, it is so tempting. First of all, thank you for having me, but it is so tempting because when you see a down 8% day, logic says buy. But the reality that we have to think about is, look, if we're soft landing and the US economy is going to be great for the next 10 years, this is the perfect vision that you want. This is the 2021 kind of vision that just takes stocks through the roof because everybody's got the Cathie Wood 5-year time horizon. And don't get me wrong, I love Cathie, but I'm really worried because Tesla just gave up its mid-term recession protection. You got to think that the people who buy Teslas are mostly 25 to 40-year-old guys in finance and tech. And they're the ones that have the biggest risk of losing their job from AI and the biggest risk of having hardship finding a new job should they get laid off. So your clientele is at big risk in a recession. You are already at flat year-over-year growth. You're plummeting in Europe in terms of growth, which happens to be where one of your gigafactories are. The Wall Street, actually, it was the Financial Times just showed Germany in potentially a 2-year recession. And so now you're in a place where you don't have a new product to help you survive the medium term. Why not introduce the Cybercab as for sale with a steering wheel and pedals, and it says fleet eligible in the future with the new hardware 5, and you can drive it with your steering wheel like normal. You know it'll be fleet eligible, and you can remove that hardware in the long term. That way Tesla could start mass producing these next year and actually generate some EPS growth that's substantial to justify this high valuation.
So were you, we talked about this, Kevin, with some other shareholders. I'm not saying they were expecting that Elon Musk was going to make some news at the event with lower price models, but they were really hoping for that, excited for that. Were you excited about that kind of new product?
I thought it was make or break. I thought if they didn't introduce a lower cost model that could be bought for the midterm, I thought that this essentially would happen and it could potentially start a downtrend. I was really hoping that they would have learned that when the rumors from Reuters circulated that, oh, we're not doing the Model 2 and the stock tanked in the spring, I would have thought logic would have told them, okay, the shareholders want a cheaper car, just give it to them. If you can mass manufacture and you're such an expert in manufacturing, manufacture these cars, even if you're only going to do so for 5 or 6 years before robotaxis take over. Have that bridge to get you through a recession, because now what you've got are existing models and hope, and not much in between. That doesn't help you in a recession. And you were also right on to point out what Adam Jonas said, which is exactly what I thought at the event yesterday as well. The robots that were probably bolted to the ground and dancing in the gazebo that nobody could get close to, those are pre-programmed, likely. The robots that are walking around doing handshakes or playing rock, paper, scissors with folks, those are all very likely teleoperated. In fact, there was someone from Microsoft apparently on Twitter who was suggesting they asked and that they were teleoperated, but let Tesla verify that. And so you don't actually have AI in robots. It's very likely that the robo-taxis were not using the FSD that we use on the road. It was some form of pre-programmed circuit on private roads, which means you don't have AI there. And the robo-van was closer to the ground than China's economy, which means one pothole takes that thing out. Honestly, I think that van was mostly clickbait, like it's some form of chassis and a cool frame. It looked cool. I got 7 kids. I would love this van. I wish Tesla had a bigger van
Kevin,
like
you
this.
have 7 kids?
Yeah, we had a little oopsies, and we messed up our fertility timing, and we ended up with twins
that's
that are about
probably
to turn
more than we
1,
need
triplets.
to know. That's probably more than we need to know, Kevin, but that's okay.
Sorry.
That is amazing. That's an amazing fact to know.
It's stressful.
So, listen, it seems, it seems obvious the way that you're laying out, the way that a lot of these analysts have laid it out, that this would be disappointing. Why do you think that the company didn't realize it needed to deliver more? Or is it just because that's worked for Tesla historically to go by this playbook?
Well, I think it's just sort of typical Elon character. And I don't actually see that as a long-term flaw. I think a visionary is typically going to be very stubborn about what they believe the future is. And I think that Elon is correct. The future is driverless. The future is everything he is doing. He is so right about the future, and I couldn't support him more. Just it's a little bit of a slap in the face in potentially a recession when you've got or near a recession, when the Fed is flying so close to the sun that they cut 50 and yields tighten by 50. And we saw the treasuries all skyrocket. It's nuts. You're really tightening this economy a lot. And Tesla is an interest rate sensitive stock with customers that are going to be most impacted if we go into recession. So I think the business side failed here. The innovation side and the vision, I'm all for it. Do I think some of it was probably more show than real technology? Absolutely. But honestly, it was an exciting event for the vision, and it made me excited about wanting to be part of the stock more and investing in it. But honestly, I'll wait for like a 150 or maybe even a 100 handle on the stock before reinvesting.
Kevin, I'm curious, if the future is driverless, do you think Elon Musk has certain competitive advantages in that market, in that race to that future?
So the answer to that is sort of twofolded. The answer currently, like in a snapshot today, is absolutely. Tesla has a massive lead. But the irony that I think a lot of folks forget is that the better chipsets like NVIDIA's Blackwell or even the H100s get, the better these chipsets get, the easier it is for other companies to use NVIDIA's drive platform or other platforms and their compute to use less data, substantially fewer miles than Tesla has driven, and end up getting similar results. So interestingly, you're up against the clock. You know, I first got autopilot from Tesla 7 years ago, and I bought it because I thought it was the greatest thing ever, and I loved it. I've been using it for 7 years. But I remember 7 years ago thinking, wow, I won't have to drive in 3 years. Yeah, well, now my 2-year-old is 9 and I'm still driving. And I'm still taking over at knucklehead intersections that FSD just can't read the road signs on, and it wants to do silly things. It's getting further and fewer in between, but the reality is that moat Tesla has is shrinking, and it's shrinking fast.
Well, and Kevin, to your point, I mean, you know, we're not quite there yet, but maybe, you know, sooner than you're going to get a Tesla van to stick all your family in, you're going to get a Waymo, maybe, to stick your family in.
Well, I think you're right. I think in the longer term, the vision that Tesla's trying to pitch is, hey, everybody's going to be able to submit these vehicles to this sort of robo-taxi network. Honestly, I think in the future, if we're going to have robo-taxis driving around, I'm going to be brand agnostic as a consumer. An enthusiast, a Tesla investor is going to want the Tesla, but everybody else is going to open up an Uber or whatever. They don't care if it's a Waymo, if it's a Cruise, if it's a Tesla. They just want it to show up faster and cheaper. And so I think that pricing power in the long term really wanes because, I mean, you see it today, and I'm sure we've all done it. You open up Uber, what? 10 minutes away, let me go on Lyft. And if that's 3 minutes away, I have zero loyalty to that Uber. I feel bad about that, but that's going to be how most consumers act. And unfortunately, that's just going to create a race to the bottom in terms of margins. I don't actually see robotaxi as profitable as people suggest it will be.
Kevin, always great to have you on the show. Thank you so much for joining us. Appreciate it.
Thank you both.
Elon Musk has said full self-driving software will be available as soon as next year, but that still puts Tesla well behind its competitors who already operate autonomous taxis. Akiko Fujita joins us now with a closer look at why Tesla has trailed in its robo-taxi ambitions. Akiko.
Hey there, Josh. Yeah, to understand the competitive landscape, you don't need to look further than the roads here in Los Angeles, where I am, where Google's Waymo operates thousands of autonomous taxi rides every day. The city is one of 4 cities that Waymo currently operates in, logging an average of more than 100,000 paid rides per week. We should point out Tesla doesn't have any right now. And engineers well versed in this technology tell me hardware isn't the issue. Software is the biggest challenge to achieving what is considered full autonomy. And to truly understand how far Tesla technology lags behind its competitors as it stands now, there's a number of data sets that you can look to. The number of driverless miles logged. Waymo has 22 million riders. Rider-only miles. GM's Cruise, which was suspended last year, of course, after an accident, has more than 5 million miles. And Tesla's technology today still requires human supervision. The other measure that engineers point to is the distance these cars can go before requiring human intervention, either because of a potential accident or because of confusion. Data from California DMV shows Waymo, Cruise, and Amazon Zoox, which, by the way, hasn't launched yet, they were able to go thousands of miles without the need for human intervention. A recent test by independent research firm AMCI drove 1,000 miles using Tesla's existing software and found that a human needed to intervene every 12 to 13 miles. Musk defended Tesla's technology yesterday and said drivers will experience full autonomy next year.
So supervised full self-driving is actually working quite well. I'm sure there's people in the crowd, you're using that, yeah? So we'll move from supervised full self-driving to unsupervised full self-driving, where the car, you could fall asleep and wake up at your destination.
As for why Tesla lags its competitors, engineers I've been speaking to point to the company's approach. Unlike Waymo and Zoox, which relies on a suite of sensors, including LiDAR, cameras, and mics, Tesla relies on a camera-based vision system, which is seen as more affordable. Phil Koopman, who's a Carnegie Mellon professor who studies autonomous vehicle safety, tells me Tesla's approach is akin to tying one hand, behind your back. Tesla has also opposed geofencing, which establishes virtual borders for cars to operate in. Koopman says that's critical to autonomous taxis today because it allows operators to restrict certain functions in the vehicle in certain areas to enhance safety. But guys, I heard you talking to the previous guest about what exactly is the Tesla advantage if Tesla is so far behind. And the thing that analysts repeatedly point to is the fact that Tesla has scale. It is not a cheap proposition here to operate these robo-taxis. If Tesla can get the software right, then they have the ability to scale up significantly and bring the price down. The question is whether they will reach that point. And of course, you've had many guests on asking questions about that today.
Thank you, Kiko. Appreciate it. Coming up, which of the ride-sharing giants should you be investing in? We're taking a deeper dive into Uber and Lyft in the latest edition of our series, Goodbye or Goodbye. Stay tuned. Much more market domination still to come.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're looking at the ride-sharing industry. Tesla's emergence in ride-hailing with its fully autonomous robotaxi could shake up the competitive landscape when it comes. So what's the best way to play the space? I'm here with Barbara Duran, BD8 Capital Partner CEO and CIO. You're back with us. It's good to see you again, Barbara. So let's talk about your buy stock. First of all, it is Uber, and Uber's already done pretty well over the past year. It's up about 80% or so. You can see on this chart. So let's get to why you still like it here, even as we have the emergence maybe of a competitor coming down the road in a Tesla.
Yeah, no, that'll be interesting to talk about. But you know, they've got dominant market share, and they're just growing their share. They're about 76%. You know, Lyft, which is the only real competitor in the space, is at about 23%. And Uber, you know, really, because they have a diversified business with the ride sharing and the food delivery, really in a way lucked out during COVID, because everything was shut down. Right. Lyft was shut down in the ride sharing, everybody was, but they had the food delivery, which really picked up. So when things opened up again, they were well positioned financially, so they could really take off. And I think you've really seen a big difference since then. You know, and so much comes down in ride sharing is timeliness, that you don't have to wait 10 minutes where you can get a competitor who's like a minute, and also pricing. But I think that's been the real difference in why they've continued to gain share, and they've also introduced all these customer-friendly Uber One. You can do a subscription, to get discounts and all that sort of thing. And they continue to expand on the food delivery, trying to go after alcohol and convenience and grocery store deliveries. So, and their cash flow. We will talk about that.
Yes, we'll talk about that.
They're dominant.
Well, let's talk first about the autonomous vehicle idea here. You think what we heard last night from Tesla shows that competition is not around the corner for Uber on this?
I think that's exactly what it shows, because the stock was under pressure for the last 4 months, really waiting for this big event, because nobody quite has figured out, and I think people are figuring out, where the AV, the autonomous vehicles, are going to fit into a business like an Uber or even a Lyft. And I think last night, as far as Tesla's concerned, production's not going to start till 26, maybe 27, and there's already Waymo, who's doing 100,000 rides a week. And so they've already got great technology. It's just going to be very hard for them to catch up. But having said that, would it make sense for them or a Waymo to start a business on their own in terms of ride sharing? And the fact is, it looks like partnership is a smarter way to go. And that's where we've had Uber partnering with Waymo and Cruise and several others. But the big one emerging seems to be Waymo, where they've already been doing sharing in Phoenix. And now they're about to roll out in Austin and Atlanta with Waymo, but with a difference. And this is going to be in early 25. What they're going to do is start to do fleet management for Waymo, because you look at how expensive it is. Those cars on average are probably $150,000 to make, you know, and that's because of all the electronics and all that. And then they'll have to be maintained and charged, and and also it's very capital intensive. And right now, Uber and Lyfts of the world are capital light, which is great. So what the deal is coming forward is that Waymo will have the advantage of all their logistics and the power of their platform, which is they have some 6-7 million drivers around the world. They have 100 million active users a month, so, and to recreate that,
Uber does,
right? If you were an AV, that'd be tough to replicate. So this could be a very interesting way to go. So it won't be a competitor, it will be something that supplements, and it should obviously benefit Uber, because then eventually you don't have to pay drivers.
Right.
So it's very interesting developments.
Do you think that they're going to beat Tesla to scale in that 26, 27 timeframe?
Well, Waymo, it looks like it. I mean, they're already out there, and they're planning to roll out, and they have, hundreds of thousands, millions of hours of driving, and they have a perfect safety record. I don't think Tesla has a perfect safety record in terms of even just using, automated equipment in their own cars that are with drivers.
Driving,
Yeah,
right.
So
right.
I think that it's going to be tough for them to catch up.
Let's get to that cash flow point that you talked about, that the balance sheet for Uber is also looking good. As you said, it's an asset-light model.
Yeah, it is. And, it was for a long time in getting to profitability, but they finally achieved it in second quarter of 23. And right now, They've got about over $6 billion on the balance sheet. Their free cash flow is huge at $1.7 billion. And they've also authorized a $7 billion share buyback. Time unknown, maybe it's over 2 to 3 years, but that's showing a lot of confidence that they can really continue to generate this free cash flow.
Let's talk about what could go wrong. We always like to talk about the risk. There could be a slowdown in consumer spending. I mean, that's something that has affected Uber in the past, right?
Right. And I'd say until yesterday, people really thought the big risk was that the AVs could come in and eventually displace them. I don't really think that's going to happen. So right now, it will always be a risk for the Ubers of the world what happens with consumer spending. And right now, it looks like consumer spending has been amazingly resilient. The Fed is just embarking on an easing cycle. We don't know, how much or when, but it looks like maybe another 50 or half a percentage point by year end. And so if the consumer keeps spending, they'll still be doing Uber rides, they'll still be doing takeout and home delivery. So that is the risk, though, if the consumer starts to pull back.
Let's look at the flip side of all of this, and that is Lyft. Those shares are also up over the past year, about 20%, but you really prefer Uber. And it's mostly in comparison, right? That Lyft doesn't look great here. You talk about it, that it's just not as profitable and it's smaller.
Right, and it's not that Lyft is a short, because Lyft got new management team in 23 in the first half of the year, a new CEO, a new CFO, and they've really worked. They got rid of like 2 or 3 layers of management. And they have really worked on operating efficiencies, going after profitability. So just this last quarter, they finally generated positive free cash flow. They finally had a profit, and the management is determined to do it. And their ridership, things are looking good, but it's going to be very tough, because you've got the virtuous circle going with Uber in a big way. You get more drivers because there's more passengers, there's more demand, and that just keeps escalating up. And Lyft, and also Uber's worldwide, Lyft is only in US and Canada, and I'm sure they're thinking about international, but will they have the funds? And they also have a big debt level.
Right.
I mean,
let's talk about their balance sheet.
Yeah,
in contrast.
it's problematic. I mean, the free cash flow is very helpful, to do that. But right now, their debt to equity ratio is something like 190%. That's pretty big. That doesn't allow a lot of room for error.
Or a lot of room for maneuvering as well. So let's also talk about how the stock tends to do. This is not responding to me as we would like, but the stock underperforms when you look at it versus Uber. It just doesn't tend to do as well.
No, and I think that really reflects the fundamental difference in the two names. You mentioned that it's up like 20%, but Uber's up like 4 times that over the last year, and year to date, from January 1, Lyft is actually down. It's down 10%, where Uber's up 37%. And then even if you look back 3 years, 5 years, if you go back 3 years, I think Lyft is down 75+%, whereas Uber's up, in over 60%, and the same kind of stats for 5 years. So I think that performance tells you a lot.
What could go right for Lyft? You sort of alluded to it already, this new management team reinvigorating it, sort of getting some momentum.
Right. And I think they can continue to improve because in the major markets where they have enough density, of cars, they are pretty competitive. But they don't have a lot of room, to try to take share. They said they're taking share, but I don't know about that. And because to take share, they would have to cut prices. They have to really be even faster to the customer.
Yes.
And that's hard. Like right now, you call an Uber, and you've probably got a choice of 4 or 5. So, I think they continue to work their way up. And so the company, if they can maintain that profitability, the stock should do okay. But you're looking at a difference. Estimates going forward are about 8% revenue growth, whereas you're seeing Uber growing at about 16% revenue growth, and that looks to continue. And then even on earnings on Uber, I mean, it's amazing, but analysts are projecting 40+% for the next few years in earnings growth. That's pretty impressive.
We'll see if it plays out that way. Barbara, good to see you. Thank you so much for
Julie.
coming in.
Thank you.
Appreciate it. And thank you so much for watching Goodbye or Goodbye. We'll bring you new episodes next week at 3:30 p.m. Eastern.
Now let's get to some calls of the day here. JPMorgan upgrading Ferrari from neutral to overweight. That's after investor meetings with top management in Asia and Australia. So talking here to their clients about what they say are idiosyncratic profit drivers. It says following those investor meetings with management, it will prove impervious to a slowdown in China. That would be a big deal, of course, since we know that's impacting other high-end automakers, European luxury brands. Emphasizes its unit volume growth, discipline, innovation, record pricing, and backlog, Julie.
Yeah, on that unit volume growth discipline, they in their note today quote the company founder Enzo Ferrari. They say he's famous for having said, Ferrari will always deliver one car less than the market demands. And so in this note, they praise Ferrari's management of sort of making these sort of jewel boxes of cars and not making them readily available so that you have that scarcity value that's built into the company.
Yeah, JPMorgan says their bottom line, we have a great deal of confidence in management's ability to execute on its long-term plan, given what they say is plentiful evidence that demand currently far outstrips supply, Julie.
And MicroStrategy is aiming for $1 trillion valuation as a Bitcoin bank. That's according to a new note out by Bernstein here. The Bernstein analyst hosted Saylor to try and figure out the special sauce here. And they basically dig into the strategy of MicroStrategy here to add as much Bitcoin as possible to the balance sheet here. And then just keep doing it as sort of this Bitcoin bank as they discussed it. Now, as we've talked about with Saylor himself, what do you then do with the Bitcoin? Do you end up lending it out as a bank? We'll end up seeing what the end game is.
Saylor, as he is when he's on Yahoo Finance, always bulled up, saying everybody is against Bitcoin before they're for Bitcoin, says this is the greatest of all technology transformations in the 21st century, Julie.
We'll see.
Sticking with it.
Yeah.
All right, come up, shares of Trump Media and Technology Group, or DJT, jumping again today. We're going to check in on the stock as well as a few other trending tickers on the other side. Stay tuned. Much more market domination still to come.
Time now for some of today's trending tickers. You can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. First up, a look at shares of BP, the company warning of weak refining margins and broadly flat upstream production in the third quarter. Basically, the bottom line here, net debt was likely to have risen in the third quarter because of those lower refining margins, and debt has been trending in the opposite direction. So the fact that it is rising here is something that investors do not seem terribly happy about. The sort of underlying oil story is that Brent crude prices fell 17% in the third quarter. So this is something that BP and a lot of the other oil companies are going to be facing when they talk about these results.
Yeah, no, to your point, Julie, noted in the statement that a barrel of Brent North Sea crude averaged about $80.34 in Q3, and that was down about $5 from the previous quarter. And then, of course, we've talked about oil. I mean, demand impacted by China weakness, saw the spike in October on geopolitical tensions, then a bit of a breather again. Just looking at Brent, back to 78.97 right here.
Yeah, and by the way, this is not the full results from the company. We get those on October 29th. ExxonMobil, by the way, reporting on November 1st.
All right, moving on. Shares of Trump Media extending its rally as it closes out an upbeat week for the stock. So Trump Media Technology Group, of course, owns the social media platform Truth Social. We know this one has been volatile, Julie. Remember, the high was about 79 in the debut earlier this year, nosedive below 12 in September when insiders could sell for the first time. Now, though, rallying more than doubled share price since late September, it looks like.
Yeah, as we know, this is effectively seen as a proxy for the former president's chances at re-election. And so the thing bounces all over the place at any given time. This week in particular, though, to your point, has been active, both on the volume front. We've seen definitely a substantial pickup in volume. Options have also seen a substantial pickup. And the shares, up something like 50% this week, are actually poised for their best week, going back to when they had the de-SPAC, when this company went public through a special purpose acquisition company. You know, I always like to look at the short interest. I'm surprised anybody is still lending out their shares in this one because it's so all over the place. 13% of the float is shorted, which is high. So, as we have talked about before, people aren't buying this thing for any kind of fundamental value of Truth Social. They're buying it because they think if President Trump wins, then that'll be good news for it.
There you go. All right, while we are wrapping up today's market domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for market domination overtime.
There's the closing bell on Wall Street, and now it's market domination overtime. Jared Blickery joining us to get you up to speed on the action from today's session. Let's start with the major averages here. The Dow closing near the highs of the session, almost up 1%, about 410 points on the day. The S&P 500 up 0.6%. The Dow and the S&P both closing at a record today and up once again on the week. In the case of the S&P, fifth straight weekly gain as well. So we've seen a run here. The Nasdaq as well, up on the week and on the day as well, although it did not perform quite as well as the other major averages. Today, in terms of what investors were weighing here, you had producer prices, wholesale prices coming in pretty much in line with estimates and not showing any kind of reacceleration like we saw with CPI earlier in the week that was alarming to investors. On the flip side, that consumer inflation is still alarming to consumers. That showed up in today's consumer sentiment report, which showed a pullback for the first time in 3 months. And it seems as though higher prices are the primary concern for shoppers. So that's something also that is that investors are considering right now. Jared, take a closer look at what went on today for us.
Yes, I'm going to bring up a 3-month chart, candlestick chart of the S&P 500 just to show you what has happened. And we broke out of a range within the last month. Looked like we were stalling out a little bit. There were some potential headwinds, but then we were just able to break higher late in the week here, the middle of the week, and close on a high note. That is, as you noted, a record high for the S&P 500 as well as the Dow. And not only up 5 weeks for both of those, plus the Nasdaq, I believe, but the Dow and the S&P up 8 of 9 weeks, going to be going for 9 of 10 next week. And let's go over some of those potential headwinds. I was looking at the MOVE index, which is like the VIX of the bond market. That shot up, but now it's been heading lower over the last few days. So that's moving a little bit in the right direction. I was concerned when it jumped up to the highs of the year there. US dollar index down a little bit. It is on a little bit of a tear. It seems to be mellowing a little bit, but if it shoots higher, that presents potential problems for equities. Going to be looking for that next week. But let's wrap up what we saw this week in sectors, financials, industrials. Both of those closed at fresh record closing highs today, and nice breakouts all around. Well, for those two. And let's take a look at the 5-day price action. It was tech and industrials. So tech was the leader, up 2.4%. Industrials up over 2%, but it was utilities down 2.5%. And that might be an interest rate play, as we did see the 10-year screaming higher for a little bit. Here are leaders for the week. So we got, looks like aerospace and defense, or transportation rather, that was up 5.4%. Here's a look at the 5-day there. And also regional banks and software, which had a nice breakout to the upside. Very long multi-year base here. I'll just show you the 5-year one more time, looking strong on software. And Josh will probably be talking about that in about 30 minutes.
We sure will, Jared. Bank results helping power a rally on Wall Street, driving the Dow and S&P 500 to new highs. The major indexes rising for the 5th straight week. And our next guest says these gains are a result of the rotation out of tech. Joining us now is Thomas Martin, Global Investments Senior Portfolio Manager. Thomas, it's good to see you. So I'm just looking how we close out here. The Dow jumps 400. It's a record, Thomas. The S&P 500 closes above 5,800. You know, what happened to seasonality, Thomas? I thought this was the time of year. If you're a bull, you're supposed to tread carefully, Thomas.
Yeah, the seasonals, if you look at it on a 1-year basis, and of course with the election, a 4-year basis, and then even combining that with the 10-year kinds of technicals, this September and October is supposed to be the time that you tread very carefully. And it seems as though that's been revoked, maybe partly because of the Fed and also just because of the stronger economic information that's been coming in. And if you look at those same factors, they bottom out on a historical basis at the end of this month, and it's not very long till the end of this month. So it's not surprising that investors are looking through that and looking positively at the markets.
So it sounds like you think things are going to keep going higher here. You know, we've been talking about the seasonals not really operating this year, and also the fact that we're at around the 2-year mark of this bull market. So what is the next leg up? What does it look like? What is it driven by?
Well, the next leg up is going to be driven a lot by earnings and earnings growth. where we had just had a second quarter that was the strongest in quite a long time, nearly 10% earnings growth. And the third quarter's expected to take a bit of a breather. But expectations have come down for that earnings growth from in the 4.5 range down closer to 3%. But again, we're looking for an acceleration based on what the analysts' averages are, and then into 2025, and a broadening out of that earnings growth from what had been just technology and communication services into 5 or 6 and into next year, 10 out of 11 of the economic sectors. So a lot of that is going to be driven by earnings growth. As long as the consumer remains strong, employment remains okay, and the Fed keeps on a sort of a gradual glide path.
Thomas, what are some, broadly speaking, some risks though on your radar? Would you focus on, is it sentiment? Is it valuation?
Well, sentiment is high. It tends to follow the market. So sentiment increases up to highs when the market is up at new highs, and that's about where we are, the situation today. And then if the market sells off a little bit, the sentiment trails off. Valuations are high, and they have been high. Those are always risks, but they're longer term risks for the market. And as long as these other fundamentals are strong, they're not really catalysts for the market to go down. The catalysts are more significant negative surprises in the very things that are strong right this minute.
Let's talk about some of the individual stocks that you like, Thomas. Micron is one of them, which has been an interesting play here because there's sort of competing visions for it, that because it is benefiting from demand for high bandwidth memory, which is something that's used for data centers, that it could do better, but not everybody's a buyer of that thesis. So what do you like about Micron?
Well, we like it for exactly that reason, and the AI theme, we believe, is alive and well and sustainable for a long period of time. 3, 4, probably maybe many years after that. But there's going to be a need for semiconductors of all kinds, and memory plays a very important role in running large language models as they are now and as they're expected to improve going forward, and for other models that are kind of below the radar, but that are also involved in artificial intelligence, machine learning, et cetera. Of course, in the meantime, Micron has more commodity-oriented memory, and memory is a commodity-like business, which is very dependent upon supply and demand and inventories. And inventories had been worked down. There was some blips there, and I think that's why the stock, which had just a huge monster run earlier in the year, and then corrected just on the back of some of those worries. But those worries were assuaged really by the last report that Micron had, where they said, look, we see demand firming, inventories are under control, and we're able to produce less than what is being demanded out there going forward. So we're very positive on it, and it's one of the few stocks that have corrected and hasn't come back yet.
And Thomas, let's talk about Uber as well, which surged about 11% in today's trade. Thomas, was that just the Tesla's robo-taxi event, Thomas, and folks concluding, okay, you know what, Uber's actually going to be just fine here?
Yeah, there was a lot of that. Both Tesla stock and Uber reacted the way you would have expected, given the robo day from Tesla. It was a classic example of long-term versus short-term, and they were the opposite for Uber and for Tesla. So if Tesla was able to solve automated vehicles and robo in the near term, or you saw a roadmap for even the intermediate term, then that was a problem potentially for Uber longer term. But the devil is in the details, and there are a lot of competitive parts of Uber that will have a chance to really come into the fore before Tesla gets even close to their version of automated vehicles. And so that's what happened today. And the stock had been off a good bit from its highs, and it's been gradually coming back. And yesterday was 5% below its high. Of course, now it's 5% above its high. But they have demand aggregation and a lot of back-end technology for the driving market. They have the cars on the road. They have the drivers. They are doing deals that keep them in the market. So they have a good way to go. They have a lot of drivers of their revenues and earnings just within their normal business. So that stock is still probably just beginning to get back started.
We shall see. Thomas, thank you so much. Appreciate it.
Thanks so much for having me on.
Take care. Coming up, it's What to Watch for Monday. We'll get you set with everything you need to know to kickstart your trading week. Stay tuned. More market domination overtime still to come.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains. We're off for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
earlier this week, Rio Tinto, already the world's largest producer of iron ore, announced it had agreed to buy U.S.-based Arcadium Lithium for $6.7 billion. That's a deal that will catapult it to become the world's third largest miner of the metal used in electric vehicle batteries. Lithium prices have floundered due to Chinese oversupply and a slowdown in EV sales, resulting in miners of the metal emerging as attractive takeover targets. Rio CEO said the company is confident long-term demand will be strong. And joining us now to further discuss this is Lithium Market is Frank Nikolic, CRU Group Vice President, Base and Battery Metals. Frank, it's good to see you. So as we noted, lithium prices have been under pressure there. I'm curious whether you think that does in fact encourage more deal making in the space.
You're absolutely right. And Rio Tinto is absolutely right in terms of looking ahead in lithium demand. So lithium is one of those universal commodities that's used across all the battery chemistries. With the transition away from fossil fuels, lithium is going to be used extensively.
It will be used extensively, but there's already quite a lot of production of it, in particular coming out of China. Now, the U.S. government says China's been making too much of it and sending it everywhere, and that's why prices are down so much. What's your take on that, and what do you think is going to happen with pricing next?
Well, prices are certainly down. You're absolutely right. And this is because of the oversupply, and we are seeing some bumps in demand given some of the slowdown in electric vehicle sales. However, mining deals are always long-term commitments. So in this case, Rio Tinto and others are looking at not the next year or the next 2-3 years. They're looking at a 5 to 10 year view. And as this chart certainly shows, the demand for lithium is going to be 3 to 4 times relative to what it is today over the next 10 years. Plenty of supply needs to come online over that time frame. A lot needs to be invested, and they're certainly positioning themselves for the win.
Frank, I actually have a basic question for you. What does make lithium so valuable for batteries? What is it about its chemistry?
Good question. So it's used it's used in essence to move the electrons about from the anode to the cathode, in the electrode and in the anode as well. So it is the right size, the right chemical characteristics, electrochemical characteristics to be viable for this. It's the best thing to do. The only next thing to consider is the sodium ion, but that's a long ways from being commercialized. So this is all we have, and it's universally used across all the battery chemistries.
And so, Frank, you talked about that we need more supply of it, and that, when we talk about this Rio Tinto acquisition, they're looking to provide more of it at a lower cost. Where are going to be the next producers, right? There is some attempt at creating more of an industry in the United States, for example, where it doesn't really exist. Brazil is a big producer, China, which we already mentioned. Where should we be looking at the next frontiers for lithium production?
Well, in the near term, a lot of Africa is going to come online, particularly the old tin mines. They have a lot of lithium in them. South America certainly continues to be a very big player. North America and Canada actually has a lot of attractive deposits, especially brines up in the prairies.
Frank, what about the U.S., though? I'm just curious. I know how much lithium, first of all, do we produce? And is there any movement to change that? Any new projects in the works?
So we're relatively to the global market, we're very small. There's a lot of interest to develop more of it as a strategic anchor when it comes to lithium supply. So there's lots of good projects to watch for. For now, they're a bit expensive, so we'll need price to appreciate a bit more, and that appreciation is going to come as demand continues to keep going up. And a lot of the producers right now are under pressure, and as you earlier said, that the prices are down. It's a good time to start hunting for acquisitions. I think the Rio Tinto one is going to be the first one. We're likely to see more ahead as well.
For investors who want to invest in lithium, what are the options? Like, I don't know how easy it is, frankly, to buy lithium futures, for example, or if those even, what does the market look like? Or do you just have to invest in proxies like the miners?
So so the lithium market is new. The Chinese started an exchange recently. I think the CME is also starting one too. So as lithium matures from a specialty chemical to a commodity, we're going to see more and more options for us to invest as retail investors. But for now, really, it's just proxy through miners.
Frank, great to see you on the show today. Thank you so much for joining us. Appreciate it.
Absolutely, my pleasure. Thank you.
Time now for it to watch next week on Monday. The bond market is closed for Columbus Day, but it will be a big day for Nike. Elliott Hill is taking over as CEO. And then on the earnings front, reporting season ramps up with more of those big banks. Got Bank of America, Citi, Morgan Stanley reporting, among others. And results are off to a strong start thanks to Wells Fargo and JPMorgan, suggesting that lower rates have not affected banks so far.
And it's not just the big banks. Some of the other companies we'll be hearing from include Netflix, United Health, and Taiwan Semiconductor. Netflix reporting its third quarter earnings after the closing bell on Thursday. And analysts expect the company to get a lift from new content and from price hikes.
And taking a look at the economy, September retail sales coming out on Thursday. Economists forecasting that number to tick up 0.3% on a month-over-month basis.
Moving over to housing, we'll be getting monthly housing starts and building permits data on Friday, and we'll also be getting a read on home builder sentiment.
And finally, we'll get some more Fed commentary from Fed Governors Christopher Waller and Adriana Kugler. Wall Street will listen closely for any clues about the Fed's next move could be within interest rates in November.
One more note. Monday, trading is open. It's not closed.
No.
What used to be and is sometimes still known as Columbus Day. It was closed for some times. New York City schools are closed. Market's not closed. We will be here.
We'll be here.
Indeed.
Yeah.
In a recent episode of the Yahoo Finance podcast, Stocks in Translation, Henny and Walsh's Kevin Mon joining to discuss the dot plot and its connection to the Fed's transparency issues. Here's a quick clip from the latest episode, and be sure to watch Stocks in Translation Tuesdays and Thursdays at 8:30 a.m. Eastern. Also, check out new episodes on YouTube or wherever you get your podcasts.
Just your first blush thoughts about the dot plots. Are they useful to you?
Take them with a grain of salt.
Yeah.
They change as much as the forecast for the weather does. As we saw coming into this year, the Federal Reserve coming into this year was forecasting a total of 225 basis points
Like
in
6
rate
or
cuts
7
by the end of 2026.
Oh, so that's even more, yes.
That was even more, 3 this year. In June, they took away 2 of those and pushed them out into 25, 26. Now in September, they not only cut by 50 basis points, but they brought back another 2 cuts. So what it tells me is that the path forward for interest rates is lower. The total amount of rate cuts, the increments that they do them within, is anybody's guess. Nobody has a crystal ball. Chair Powell doesn't have a crystal ball.
He's very careful to say, he almost says himself, take these with a grain of salt. These are not predictions. These are just, projections by individuals that happen to be aggregated. I guess it comes back to the question, has the Federal Reserve gone overboard on communications? They had a big powwow a few years ago around the pandemic time, coincidentally, and they said, yeah, we're going to dial some things back, but has it been enough?
Over-transparency has led to a great deal of confusion because now the market tries to parse between everything Chair Powell says or doesn't say in each one of his press conferences. Remember, they only update that dot plot chart and their summary of economic projections 4 times a year.
That's 4, yes.
All those other meetings, they just announce what their actions are or not. So we only really get to hear from them 4 times a year. So we're left guessing and speculating in between each one of those meetings and parsing all their words. And then, of course, he comes out like he's the coach of the New York Jets at the end of the game and has to deliver a press conference and account for why they did or didn't do something, or account for why Aaron Rodgers threw 3 interceptions yesterday and the Jets lost. I
just want to hear Powell say, we got to get back to fundamentals here.
Wouldn't that be great?
Yeah.
The dot plot is only like a decade or so old, right? 1 or 2 decades old.
Yeah.
So what was life like before we had the dot plot?
Tell us, Kevin.
Yes. And I've been on Wall Street for 32 years, so I remember. So prior to that, it was really Fed chair people such as Alan Greenspan coming out and telling us what their thoughts and projections were for the market, serving as the one single voice beat for all of those voting members. The one thing to remember about this dot plot chart, though, as Jarrett pointed out, each dot represents a different view of that voting member for where they believe interest rates are going to be this year and the next 2 years. But if you look at the dot plot chart, there's no unanimity there. In fact, the dispersion between those thoughts and those forecasts are quite different. So for all of those economists and all of those investors who rely upon the dot plot chart, take it with a grain of salt. It's a good tool, but you shouldn't be making investment decisions on that basis alone.
And why are the dots? They're anonymous, right? But then you hear Fed officials
people try to
speak.
match them up, and it's this big game that people
Right,
do.
but what's the point of them being anonymous at that point?
Well, that's a deep philosophical question.
You know,
They're transparent to a degree.
Average Joe here, just asking a question.
Well, you know what's
That's a very
funny
good
is
question.
like way back in the day, this is before I was covering markets, and you go back to the 80s, but maybe even 92, you didn't get a Fed announcement on the day. You had to look at the money supply statistics the following week to infer what the Fed was doing. Were they cutting rates? They didn't tell you. You had to infer
Yes.
that. So now we get like transcripts on a 6-year delay. They had none of that.
Nope.
But I guess to the point that maybe they've gone a little bit overboard.
Overboard, yes.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Are you a passionate investing bull? Maybe you love scooping up shares of NVIDIA on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. Stocks closing the day at new records again. And the Dow and the S&P 500 notched weekly gains for the fifth straight week. A closer look at what's been driving the market action ahead. Plus, what bank earnings are telling us about deal flow. We've got expert insight into what could be on tap for 2025 as interest rates come down. But falling rates not having the same effect on commercial real estate. New data showing that loan delinquencies are near pandemic highs. A closer look at the implications ahead. Deal making showing signs of life, fueling big jumps in investment banking for Wells Fargo and JPMorgan. While deal making activity did dip in September, there may still be a chance for it to return to pre-pandemic levels. EY America's Vice Chair of Strategy and Transactions, Mitch Berlin, joins us now to discuss. Mitch, it is good to see you. So maybe, Mitch, start big picture here. I mean, when you look at the environment right now, do you see this as a healthy, strong backdrop for M&A, Mitch?
Josh, yeah, I do see it as a healthy backdrop. The first 8 months of the year were strong. We saw a 19% year-over-year increase. September was a little soft. I imagine it will remain soft throughout the election. But overall, it's been a strong year, 90% increase in volume, 19% increase in value. The capital markets are strong. The economy is getting stronger. The cost of capital is going down. So all the signs are pointing in the right direction. You mentioned the election there, Mitch. I'm just curious. You think how much of a factor is that? Do you think CEOs maybe sitting on their hands here, saying, "Listen, I'll wait till this election is over. I'll wait to see who's in the White House and what that means for the kind of regulatory backdrop"? I think that's one of the factors. First, we know that about 34% of the CEOs that we surveyed stepped away from deals just because the cost of capital was too high. So we see that coming down. So that's a good sign. But it's also hard to build volatility into your models when you don't know where that source of volatility is coming from. And so under one administration, that volatility can be coming from transacting in areas like China. Under another administration, that volatility can come from greater regulatory scrutiny and delayed deals and perhaps having to carve up your deal into a different structure than you initially anticipated. So I think once people understand what administration is in the White House and in Congress, they'll be able to build better models, give their boards greater confidence, and move forward with their deals. And Mitch, to the extent that we see a pickup in activity, are there certain sectors, certain industries, Mitch, where you'd expect to see that pickup? Yeah, Josh, I mean, technology is always hot. It has been for the past 3 or 4 years, and it will remain so in 2025. That is the number one sector with a significant increase year over year, about, I'd say about 30% increase in volume year over year. And that's because you have non-technology companies that need technology to improve their front office operations, their back office operations. And then you have the general desire to acquire AI, and clearly cyber technology is top of mind for everyone today. So tech is really top of the charts. After that is really consumer products with about a 34% increase year over year in volume. And you see a lot of private equity playing in the consumer product space, particularly around food and beverage. You also see a lot of activity, interestingly enough, around food companies that do private labeling. I imagine this is a reflection of the increased cost in groceries and the desire to buy private label versus branded label to save on costs there. And then the other sectors that remain active are life sciences, and then oil and gas, of course, continues to have another bang out year. I'm impressed by oil and gas because, Mitch, and we've covered a lot. I mean, there's already been so much activity in that energy sector. There has been. It's going to continue, Josh. We are speaking with clients that are looking to do oil and gas deals. So the pipeline is very robust in oil and gas. We have consolidation around the supplier base is one of the motivations. We have divestitures of non-core businesses. So these companies can invest more in renewables. And then we see a lot of activity in downstream as these oil and gas companies look to build a retail presence as well. So those are some of the motivators behind that activity. Switch gears a little bit, Mitch. I'm curious to get your thoughts about the IPO market, your outlook for the next 12 months or so. We've had some guests recently on, Mitch, on the show, and I think they've sounded kind of skeptical, at least for tech companies. And I think at least one broad point they made was that
a lot of these companies have just raised so much money already that why go public in the next 12 to 24 months? Sit back, focus on growth, don't get distracted. But I'm curious to what you see broadly for the IPO market in 2025.
I think we expect a modest pickup. The IPO market has been pretty steady over the last 9 months. I think we'll continue to see some activity, but I agree. I don't think there's going to be a significant uptick. And just from the people and the CEOs that we're talking to, we're not seeing anything substantial over what we're seeing this year. I think your prior guests were correct on that.
You did mention private equity. What kind of position are they in, Mitch, as we roll into 2025?
So surprisingly, private equity is doing well. We do a deal barometer every year, and we expected private equity to grow at 9% this year. It's already at 13% in volume year over year for deals over 100 million. I think we'll continue to see private equity pick up, particularly as the cost of capital goes down. We've already had one cut. We may have 2 more cuts this year, probably another 100 basis points next year. So overall, a 200 basis point cut from our high. That means the cost of capital is decreasing. And of course, that allows private equity to do more leveraged deals. They're also sitting on over $1 trillion of dry powder. So clearly they need to move on that. And then they have assets that are very mature and the investors want to see their money. And so as the bid-ask gap narrows, we're going to continue to see more activity in private equity. As a matter of fact, we did a PE Pulse survey a few weeks ago, and about 66% of those participants said the seller came down in their overall price to meet the buyer's demand. So we are seeing some movement in the bid-ask gap. So all those things are pointing signs to say that we're going to continue to see an uptick in private equity.
Mitch, thank you so much for joining the show today. We covered a lot of topics there. Appreciate it.
Thanks, Josh. Have a good weekend.
You too. The Dow and S&P 500 hitting a 5th straight winning week while notching new highs. Yahoo Finance's Jared Blickery joins us now with more on the trading day takeaways.
That's right, another week of records and some more rotation. You thought the mega caps and the Mag 7 were out. Well, this week was dominated by tech, but really in the software sphere. And that's why I say tech roaring back. But there were some other interesting plays too, which we'll get to. First, I'm going to cover the sector action. This is over 5 days. And you can see there, Josh, as you're walking up to that XLK right there, up 2.5%. Closed not at a record, but XLI did. XLF it did. That was number 2 and 3. Healthcare also outperforming the S&P 500. Want to just show you what's happened over the last month. Now we have energy actually in the lead. We had WTI crude pickup, and we are also seeing industrials in there, communication services now. You take a look at the Nasdaq over this time. Hasn't necessarily been about the Mag 7, but we're nevertheless seeing some great gains by NVIDIA, pressing up against its record highs, and Meta. So kind of, I wouldn't say roaring back maybe, but just kind of inching back. And just at the same time, we have the industrials and the financials. We got earnings season going on. So there's a lot of things in play, but all of the potentially bearish headwinds that we've been talking about, all of those were discounted because we ended at record highs.
All right, so that was U.S. focus.
Yeah.
What else you got for me?
Well, I got China, and that kind of leads me to number 2. First of all, in terms of weekly flows, I did want to add that emerging markets just experienced their greatest flows ever, and that just
greatest flows ever.
Greatest weekly flows ever for emerging markets. But China is still included in that EM basket. Somewhat disputed because they are now a very advanced economy. But why do I say that they're channeling Keynes? That is because they have released basically $500 billion of stimulus. That's both on the monetary side and the fiscal side, more monetary, but this is covering margin debt. So this is something that really tracks the retail traders. This goes back to 2018. What I want you to focus on is this spike right here, because that happened within basically the last few weeks. And that just shows you that the retail trader there over in China is participating. The problem is when you compare this stimulus to like 2008 and 9, that was 20 trillion yuan. That was almost $3 trillion US. What we're talking about today is $500 billion. That's what's been done so far. Over the weekend, we're expecting another announcement, maybe 280, 300 billion, but that's not even 1 trillion yet. So the dollar,
not enough.
The dollar amounts are just not there yet. It's going to be really fascinating to see where the Chinese stock market opens up on Sunday evening here in the US.
I'll be waiting.
Yes. All right. October headwinds, we got to talk about seasonality again because this is an election year. October doesn't usually do that well during election years. Now, we talked about seasonality in September. That was supposed to be bad, didn't happen. October so far is positive, but what you're going to notice here is right in the middle of the month, which we're kind of approaching right now, next week, then we see some of those negative headwinds assert, and then we kind of inflect at the end of the month. I don't have to add that we have the election sometime over here in early November, so there's a lot going on, and maybe we just wait until that time to resume the trend, but there's so much bullishness right now. I wouldn't be surprised to see some pockets of breakout. Even if the indices don't do much, look for individual sectors.
And finally, it's Friday. We're heading into the weekend. Let's end on the dollar. Oh. Because I know you want to.
Yeah, we got to end on the dollar. I always say watch the dollar because that's what you kind of got to do in these circumstances when the Fed is lowering rates and interest rates are actually rising, doing the opposite. So let's take a look at what the dollar did this week. This is the US dollar index. Let me put a year-to-date chart on. Not going to, you can kind of see this rise here. Let me dial this down to a 3-month chart. There you can see this is basically 2 weeks. So we didn't do that much this week. It was last week that was kind of the breakout. Nevertheless, that gives me a little bit of pause because on a 10-year basis, we are launching, let me give you a 20 actually, we are launching off of some important lows here. Now we can see, it just looks like a tiny little consolidation. On a 5-year, it's a lot bigger, but you're gonna see as we try to launch from these lows, if we go up to these highs, that causes a problem. That tiny little move right there, that could cause a problem.
I'll be watching, Jared. Thank you, buddy.
You bet.
Stick around, more asking for a trend still to come. Loan delinquencies continue creeping up toward the pandemic highs, increasing for the 11th consecutive month to 7%. But will the Fed's 50 basis point cut in September alleviate that situation? For more, we're bringing in Kevin Fagan, head of commercial real estate economic analysis at Moody's Analytics. Kevin, it's good to see you. So maybe start actually higher level, Kevin. I'm just curious to get your kind of broad take. If you look at the U.S. commercial real estate market now, Kevin, I asked you to compare it to, let's say, 12 months ago. How would you characterize it? The same, better, worse?
I think at a high level, it's probably maybe a little bit worse in certain ways. In other words, from what we call the space market, which is the market for, taking down commercial real estate space in terms of tenancy. Rents and vacancies have kind of gone the wrong direction overall. But then on the price side, prices have been relatively stable. I think that we're probably in what we would call a normalization period.
Are there differences that, that kind of stand out to you regionally, Kevin?
Yeah, I mean, first of all, we had a big migration down to the Sun Belt, which I think a lot of people are pretty aware of, but that got a little bit overheated and there was a lot of new construction. So we had a lot of new inventory and the demand started to taper down a little bit. We've actually seen a reversal from growth in the Sun Belt and improvement in Sun Belt performance metrics to moving to the Snow Belt, like back to the Northeast or the northern Midwest states. So again, a bit of a normalization there as well, as where we had kind of a weird period of overheatedness that there's a correction for. But generally speaking, that's one of the major trends, and you kind of have some markets that are worse than others, like San Francisco's been, the redheaded stepchild, to use an old phrase, for a little while now, but even there's been some improvements off the bottom there.
I'm curious now, now we have a Fed deliver that supersized cut, Kevin. What kind of a ripple effect would you expect that to have in the market?
Well, the CRE market's going to react pretty slowly to that. It was a big cut. I think it's, now that we got that jobs report last Friday, we'll probably find out that the first cut was the deepest, to quote Cat Stevens or Rod Stewart, depending on your preference. But, we're probably looking, I think we still are holding on to a 25 basis point cut in the next 2 months, but pretty likely that the Fed is going to be cautious about that because the labor market has shown really, really good strength while inflation still remains a concern. But the bottom line is that what really matters to commercial real estate is that we're getting certainty around rates. And we're actually starting to see transaction volume finally starting to tick up. It went positive for the first time in over a year. Year-over-year transaction volume went positive last quarter. We had 2 quarters in a row of positive lending volume. So that while it's not, the numbers aren't anything to get excited about, the momentum is going in the right direction, and rates, stability around rates in particular will help that.
Do you, Kevin, have any line of sight into office attendance and trends there?
Yeah, I mean, it's still well below pre-pandemic levels, but it did improve significantly over the last year, meaning office utilization rates, where people are going back into the office more. We're settling into this, hybrid is probably the best approach for, kind of the straight average professional services company with a lot of range around that. But what's really important for real estate is for us to figure out what kind of space are tenants going to take per employee now in this hybrid work environment. And a lot of tenants still aren't sure about that. It takes a long time for these leases to roll over. We're looking at something around maybe a 10, 12%, and a lot of other forecasters are kind of coming around that as well. It seems very likely. But the point is that we're kind of normalizing a little bit there, but we really are probably about 2 years from having a real handle on what normal means for the office.
One trend that I always thought was so interesting, Kevin, was always that talk about reimagining and reformatting commercial buildings as residential buildings. I always thought it sounded just so challenging, just the bureaucratic and regulatory red tape you'd have to step through. I'm just curious, is that any sense of whether that was an actual real trend?
It might become more of a real trend over time. It's going to depend a lot on governments helping, or getting out of the way and letting it happen. But it's a really idiosyncratic story. Sometimes you think it's going to be a good deal, but when you're a developer and you get in there and you run the numbers, you realize, you have inoperable windows in an office and they have to be operable. And just there's a laundry list of things like that. and it's very hard to make a profit. So it's probably going to be a fringe trend unless governments really start stepping in. But there's idiosyncratic stories. I mean, there was a project in Jersey that was an office, campus that got turned into senior housing. And that worked out well because the individual buildings became like dorms, and right next to there was a golf course and a funeral home. So it was just perfect for putting into senior housing. And so there's going to be stories like that. There's very obsolete offices in some of these cities that are Class C, really old, and they either get renovated into another modern office or they become something else. But it is kind of on the fringes. Office is still going to be an important part of the workplace and of commercial real estate.
Kevin, great to see you. Thank you for helping us walk through the topic. Appreciate it.
Thank you.
Coming up, Boeing shares taking a hit after hours as the company has announced it will cut 17,000 jobs. More on that when asking for a trend returns. Breaking news here, Boeing announcing preliminary third quarter results and cutting 17,000 jobs, which amounts to 10% of its workforce. Praz Subramanian, Julie Hyman are here. Guys, bringing in these headlines. So Boeing planning to cut about 10% of the workforce here. Memo from CEO Kelly Ortberg, our business is in a difficult position and it's hard to overstate the challenges we face together. Praz, your reaction to those headlines?
I have to say, it seems like a pretty steep number there. I mean, 171,000 total employees, so 17,000-ish job cuts, like you mentioned. That's kind of the back of the hand math that people are working with here. Coming across, like you said, executives, managers, and employees. Does that mean union employees? I don't know. It's hard to say, but it sounds like it is. And that's pretty steep there. And they're also going to push back the 777X wide-body jet, so that's kind of a big deal to 2026. So that to them, that's their next big plane. That's not going to happen anytime soon. So again, steep cuts here and a lot of financial losses. I know Julie's been looking through that.
Yeah, I've been looking through that as well. As you mentioned here, the company now saying that its third quarter revenue preliminarily is going to be $17.8 billion. About $18.6 billion is what analysts had been anticipating. And they're taking various charges also related to this. The third quarter GAAP loss is going to be $9.97. Now, the backdrop here, of course, is that Boeing has been troubled for quite some time, as we know, has been under investigation by various entities. Kelly Ortberg just took over as CEO in August, and this is his first sort of big move for the company. The backdrop for that, of course, is, as Praz sort of alluded to, by saying we don't know if union employees are involved, is they're undergoing pretty tense negotiations with their union, and they're not even are they even at the table right now,
No.
Ross?
After 2 days of, I guess, mediation, they both walked away. Boeing pulled their latest offer, so there's no actual offer on the table right now. And the union says, "Fine, we're in the right here. We're gonna stick this out until Boeing comes back to the table." So they're not in a good shape right now, exactly. And we're seeing this pre-announced right now, showing that.
All right, let's bring in another voice here, because joining us now is Mike Boyd Group International President. Mike, it is good to see you. I want to get your take on these headlines, Mike. Do these moves, in your opinion, do they make financial and strategic sense, Mike?
They're momentary. They got to react to this strike nonsense. But let's keep in mind, I think you had brought this up earlier, Boeing has more problems than the IAM walking up and down a picket line. Doing what they just did is things they have to do. When this gets settled, if it gets settled anytime soon, but it's got to get settled, they got bigger problems. They got no product to go forward with. They've got a production capability, or they have a production limit. They can't deliver the 10 like they're supposed to, the MAX 10. We got an airline or an aircraft manufacturer that's in very, very deep trouble. And what they just did here, maybe just the beginning, because this is not a drill. Boeing is in deep, deep trouble.
Well, and to your point, Mike, the trouble goes way beyond the union negotiations. So in your view, are these cuts in response to that, or might they have happened regardless?
Well, judging by the kind of management they had in the past few years, I'm sorry, they've just sat on their hands. They're ossified. I think these are things that they're doing probably because of the strike, not because they're brilliant managers per se, because we don't have that. So I think going forward, Boeing's going to have to figure out, are they going to have a product in 10 years beyond the 737, which is beyond its life now? Are they going to have a production line that's going to put out enough airplanes to pay the bills? And at the bottom line, are they really going to be in the global marketplace? Right now, the current management they have for the past 10 years, they're paying a hell of a price for them.
Hey, Mike, Pross here. So what does this mean for Boeing's kind of relationship with Airbus, right? Airbus is kind of going forward with their new planes, and Boeing just delayed the 777X. So what does that mean for them in terms of the future?
Oh, it's great. This is supposed to be a European company that can't get out of its own way. Look what they're doing. And people say, well, their order book is full. They have 72 acres sitting down there in Mobile, Alabama, and in a year and a half, they can have 2 production lines cranking out airplanes. It's a bright future for those people because they've planned for it.
Mike, thank you so much for hopping on and giving us that insight. We appreciate it. Our thanks to Julie and Praz as well. That's a wrap on today's Ask for a Trend. Have a great weekend.